the last month, a lot of people have been just telling me, listen, we've seen sales come down. In some areas it's working, but we're actually seeing a big difference compared to the month before. And that's what happens when you raise rates so fast, because you're seeing on a dime things switch. People turn off. Like, we're not talking about slowing down inflation or slowing down the economy. We're talking about right now, with the pace of your rates, you're shutting off the economy. You're going to shut off the entire economy. And that's what's going to happen if you raise too fast. It's not going to be, oh, we need to do this to combat inflation. You're doing it. You've done it, right? You have inflation under control. It went up a little bit last month with the CPI. Again, if you look at a lot of different indicators, it hasn't gone up. It's going to slowly go down. We're at 6.5% mortgage rates. You're taking the whole housing industry out of it. Again, we had, weak housing statistics again today showing that, home prices are coming down. But if you're raising too fast, this is what happens. You completely shut off the economy and people stop spending all at the same time. And that's why you're seeing these industry by industry, whether it's retailers, it's home builders, it's the chip sector, now it's industrials, now it's FedEx. Immediately, like, they're like, things are great a quarter ago, and now they're like, holy shit, we lowered earnings by 30% because everybody just stopped spending and was surprised. There's no surprise, because these things hit you like a pound of bricks right in the face. It's not like, oh, okay, gradually we want to control. If you're going to do it this fast and people are calling for a 1.2 quarter rate hike and get ahead of it, you're already ahead of it. You finally caught up to it. Now you might have to go a little bit higher. We understand that, but to really just blindly say, like, we're going to raise rates, like crazy going forward, it seems like they're going to do that no matter what without looking at the data. And you have to be looking at the data, and that's what the Fed should establish at this meeting, Daniel. They have to come out and say, we're aware of the data, and some of it, you could say a lot of it, is showing deflationary signs. However, food is still high, rental's still high, we're still seeing inflation, so we're going to continue it. But they need to address that they're seeing it, because if you're not addressing that you're not seeing any of those things, that's what scales the hell out of me. Because that means you're going to significantly raise rates higher from here, and I don't think the market's definitely not pricing that in. Even with the 2-year topping 4% for the first time since 2007, it's not pricing in 4% plus rates for the entire year next year. And if you are pricing that in, you have no idea what that's going to do to businesses. Because even the banking sector is a good indication, right? The banking sector you should see massive, massive, massive profits, because higher rates are great for them, right? So it's just that net interest margin, it goes up tremendously. And when we had zero rates, they found ways to fee you to death. Everything was a fee, right? And then you had a market where M&A was strong, your SPACs were strong, they're getting involved in all this investment banking stuff, and things were great. When you raise by this much, the bank should be doing great. However, you completely turned off the IPO market, the M&A market. It's almost completely turned off right now. You're going to see some M&A, but not a lot. I mean, you're going to see really a lot of these technology companies start aggressively buying other companies right now in this market, where they're seeing earnings decline sharply. They're supposed to decline 12% year over year. So the banks are a good indication that you're doing this too fast. Because they should see huge growth, and they're not. They're actually going to see earnings year over year decline, because every other facet of the business has been completely shut off. And that's what scares the hell out of me. You don't have to completely shut off the economy and shut off everything, okay? Little by little, this should be a gradual approach. But these 75 basis point hikes, people are talking about on CNBC like this is normal. Like, oh, we should go 1%. This is perfectly normal, without understanding the true ramifications of this, because it's going to be a freaking disaster, and the Fed could actually avoid it just by the way they talk. So let's see what they say today. It's going to determine what we're doing in our portfolios, because they're like balls to the wall. You can't own equities. If they're really serious with what they said in Jackson Hole, with all these indicators showing that you've seen deflationary trends, more deflationary trends than we've seen in a very, very long time, and you're not even acknowledging them, you can't really own equities over the next few months until the Fed decides to say, okay, all right, we're almost done raising rates. And we have to be near there, especially if this 75 basis point hike. We'll see.
Yeah, the Q&A today is going to be one for the ages. Does CNBC have a countdown clock on yet?
No, but
I know they love the countdown clocks and markets and turmoil and all that.
They actually have Biden on right now.
He's at the is it G7 or UN?
Yeah, the UN. He's talking about the UN. But they have like the banking sector, they're testifying. I don't know why that's a big deal.
No, that's why it's on your mind. They got the bank. Oh, it was the keeping the giant banks accountable or something.
Yeah, I mean, it's so funny, the whole banking sector. It's almost like that. The government sets up and they talk to all the CEOs and go, okay, look, we're going to fine you this much on this date, and we're just going to say something about this. Still, I think that some of them are still getting fined for the housing crisis. And Jeremy Dimon was like, I think like a year or two ago, he's like, all right, I don't know if enough of this bullshit. Okay, enough. I mean, it's almost like, how much money do you want? Here you go, leave us alone, kind of type of thing, right? So. Yeah, it's just so funny the way that it's whole smoke and mirrors here. But I guess there's nothing to talk about because it's very difficult to either recommend stocks or not recommend stocks. I said that I wouldn't be surprised if we go up 1,000 points here because there's so much negativity. And if the Fed just comes out and says something a little positive, it's fine. But I think if you look at it from a risk reward perspective, the market going up sharply from here and just the risk you're going to take, because I don't know what the Fed's going to say that we don't already know on the negative side.
Right.
I just think it's a good risk reward trade. But still, you're raising rates considerably, and we don't see markets bottom when you're raising rates. We just don't see that and until that cycle is over and the Fed's kind of saying, listen, that cycle's not even close to being over. So we'll see. Yeah,
I mean, history is a good roadmap to look back on. Again, it doesn't guarantee future performance and or direction, but you have to, you can't ignore that. And to your point, and another scary data point I believe I read was in order to really kill inflation, you got to get the Fed funds rate above inflation. Yeah. Well, that's not going to happen this cycle because you can't. I mean, you could, but you talk about shutting down the economy. You know, how about
inflation's not expected to go below 5%? I think maybe about 5% by the end of next year, maybe to 4%. It's going to come down, but it's going to come down slowly, right? So it's just. But if you want it down like sharply, this is what you do. But you're risking shutting the global economy off, shutting it off. Not just, hey, we want to slow this down, which is normally for the Fed and the way they talk. And, a gradual slowdown, no surprises. They just come out and say, we're going to raise rates. I mean, it's just uncertainty because you really don't know. And that's why we're having so many of these conversations. And that's a conversation on Fast Money and all these shows is like, how much are going to raise by? They're not going to pivot. We shouldn't be talking about this. We should know exactly what the Fed is doing. When you know exactly what the Fed is doing, and that's how they translate it since the 2008 crisis of, hey, this is what we're going to be doing coming up. It's resulted where you could invest accordingly. But you really don't know because the Fed says what they said in Jackson Hole and saying we see no signs of inflation slowing based on one indicator, CPI, which you have to stop looking at that because if you look at the CPI, I'm telling you, you're going to go over 5% rates because that thing is not going to come down with rentals 30% of it. And you're just not going to see that come down fast. And that scares the hell out of me because you're going to see everything else absolutely collapse. And we're seeing it. We're seeing it lumber. We're seeing it copper. We're seeing it cotton. We covered yesterday. You're seeing the housing market being shut off. You're seeing it in a lot of different industries. So, good luck to that. On another note, I will say this. I was surprised. This is really surprised from my Canadian friends, but they're going to lift vaccine requirements for people entering the country for Canada. I saw you were trying to break the internet with a tweet there about where you had to actually say it's sarcasm. It's not near as funny when you have to say it's sarcasm. But you have to. I mean, I got cooked off Twitter. I said now DeSantis has someplace else to send everyone coming over the southern border. And I said I said I'm being sarcastic for the crazies out there. a better humor is like beauty. Beauty's in the eye of the beholder. But the funniest thing was the Martha Vineyard thing. They sent 50 or 60 immigrants, and somebody on Martha's Vineyard, they were doing different, asking residents and things, and they said, well, we don't have the room to house 50 more people. It's like, well, I don't know that you can. Almost every city or town could probably take on 50. I mean, did you see the size? Someone put a picture of one of Obama's parties. Well, I don't know whose house it was. Massive tent that fits like 300 people. Exactly. Yeah. Like, well, yeah, but that's funny. It is sad when politics are being played, but hell, we're being played in politics as well as pawns. But yeah. So something to tease for tomorrow. What I'd like to talk about is I want to stay on this energy kind of conversation because everything that's going on between Russia and Ukraine, Putin gave a speech and was more aggressive more hawkish than dovish and calling in troops and kind of beefing that up. There's elections over there going on in Ukraine. Then you have more sanctions and, lack of a better term, silliness that's going to go into effect later on over the next coming months. And if you try to cap the price of oil, different things have been tossed out there in the European Union and things like that. My point to all this is that we have a lot of articles and things, Frank, to talk about how we think this is going to unfold over the next couple months. And if they continue on these sanctions and this path, it's going to disrupt not only the oil and gas markets, but then it's going to ripple through the shipping industries. We want to take a look at advantage of that. We did well in Nordic American Tankers, I believe in CVO a good while ago on a quick trade. And I think there's going to be, I need to get it right, so we need to timestamp this because that opportunity is coming up again, if not right now, where you can start adding. Again, I'm looking a few months out into December, I believe these. We can talk about this tomorrow, but, obviously the elephant in the room is the Fed and the Q&A today. However, very little of what he says today, either way, is going to change the energy markets going forward in the near term. That's a positive for investors that you need to not ignore.